I think first, multiple, presenters have been talking about this, but everyone's trying to figure out what's the one risk that is responsible for what Mike said before, which is no bids. And it's not any one risk. There's quite a few. Retail and institutional investors are all trying to price in 3 or 4 big risks at once. And when you get these type of major gyrations, you get a vortex. And that vortex is about no bids. It's about repositioning happening all at once. And then everyone trying to find an excuse. So our message to our clients is stay disciplined, exhale, relax, rebalance during times like this, because you only get 3 or 4 invitations per year when the profit cycle, frankly, is still heading forward, even though it doesn't feel good right now. So stay disciplined, stick to your investment process, own high quality, and reposition all the way through this. And this is why diversification is so important. And we say it a lot, but it's rarely practiced until you need it the most, like now.
Yeah, I'm sure a lot of clients, though, Chris, don't want to even touch their portfolios on days like today. How do you convince them to, what are you telling them to reposition into?
Well, first and foremost, in our CIO models, we've been expressing high quality for a while, trying to get diversified. We're still equity overweight. We're still overweight the U.S. and generally speaking, balanced between large and small. And we've been moving from growth to value for quite a long period of time now, well over the last, say, 9 to 12 months. So for those that are in the models, that's what we're doing. For those outside the models and the centralized investment management, what we're counseling them to do is if you have still overexposure, it's not too late to rebalance into the areas that have solid balance sheets, are expressing cyclical growth and cyclical value. Mike talked about it before. Semis are down 15%. That's a networking hardware connection area of established tech that can pay you while you wait and actually come out on the other side in very good positioning. So we want to pick our spots, and everyone's been saying this, Melissa, which is, the market provided the return for the last couple of years. Now the return is below the index, and that's what we have to continue to hunt for.
If you want to look for a silver lining, maybe, we do have the probabilities down to 25 basis points for a March increase
yes.
for the Fed. They had been going up toward 50 basis points, a double. So maybe there's something the market can hang on.
Yeah.
Not sure
it's one of those
reason.
Be careful what you wish for, because if you wanted the Fed to be less aggressive, the way to get there is for people to have a little more doubts about the growth outlook and whether the market can handle it. And obviously financial conditions already tightening a fair bit. But also just after the minutes, there was no confirmation that the committee as a whole was steaming in that direction. And it's actually interesting. I keep pointing all week to the equal-weighted S&P because it's at least holding up somewhat better. We are still getting a heavy skew from the very largest stocks that have been giving way. It's the ongoingness of this valuation adjustment that we've been seeing for a while in the largest stocks that did so much of the work last year. So been also pointing to, this whole 2015, 2016 period. We also were gearing up for the first rate hike in a cycle. And you had the same kind of, multi-week, actually a couple of months of correction, ultimately got you down 15% in the S&P. And by the time we were in the end of it, the talk was, you know what, we've actually been in a stealth bear market for a while. That's what everyone's saying kind of right now, talking about most of the, the high flyers peaked in February and the cyclicals peaked. So I do think there's some similarities to that market rhythm of by the time you realize things could get really bad, a lot of the damage has already been done.